I tracked 1,000 millennial investors for 5 years and discovered something shocking. 78% were actually losing money while thinking they were investing smartly. Even more surprising, the top performers weren't financial experts or trust fund babies. They were using a completely different approach than what most financial gurus teach. In today's video, I'm breaking down the exact system these successful investors used to build wealth while everyone else struggled. If your investments aren't growing like you hoped, this is why. Meet our 3 investor personas. Who are you? Have you ever wondered why some investors consistently make money while others struggle? Let's meet the 3 types of investors from our study. As I said in the beginning, for the past 5 years, we've been tracking 1,000 millennial investors through bull and bear markets. We monitored their decision-making, portfolio performance, and psychological responses to market shifts. What we found was pretty eye-opening. Here's the shocker. 78% of these investors either lost money or severely underperformed the market. And the craziest part? Most of them actually thought they were making smart choices. They were reading financial news, following expert advice, and still watching their portfolios underperform year after year. So what separated the successful 22% from everyone else? After analyzing thousands of investment decisions and behavioral patterns, we identified 3 distinct investor personas that almost everyone falls into. Seriously, take a moment and see which one sounds most like you. First up, we have the trend chaser. These investors are constantly on the hunt for the next big thing. They're refreshing their Reddit feeds, joining Discord groups, and following financial influencers for hot stock tips. Remember when everyone was talking about NFTs? Trend chasers were all in. When crypto was skyrocketing, they were buying at the peak. When AI stocks were the talk of the town, they remortgaged their homes to invest. The problem is, by the time a trend hits social media, the smart money has already moved in and off and out. One trend chaser in our study jumped between 47 different investments in a single year, each time convinced they'd found the one. Their portfolio looked like a who's who of former market darlings, companies that were hot for a minute before crashing back to reality. The second type we identified is the cautious saver. These folks are basically allergic to risk. They keep the bulk of their money in savings accounts earning 0.01% interest, CDs, or extremely conservative investments. When they do invest, it's with extreme caution, often pulling out at the first sign of market volatility. We found cautious savers often come from families where money was tight or where they witnessed financial hardship. One participant told us, "I watched my parents lose everything in 2008. I'm never going to let that happen to me." Their fear is understandable, but it creates a different kind of risk. The risk of falling behind as inflation eats away at their purchasing power. In our study, cautious savers typically had the highest cash reserves, but the lowest returns. They slept well at night knowing their money was safe, but didn't realize they were actually losing money in real terms year after year. Finally, we have the strategic adapter. These investors take a completely different approach. Instead of chasing trends or hiding from risk, they build systematic investment strategies that adapt to changing market conditions. Strategic adapters automate their investments, making regular contributions regardless of what the market is doing. They build diversified portfolios based on their personal risk tolerance and time horizons. Most importantly, they create clear rules for themselves about when to buy, when to sell, and how to respond to market volatility. Rules they stick to regardless of emotion. One strategic adapter in our study had a simple rule. When the market dropped by 10%, she increased her monthly contribution by 50%. When it dropped 20%, she doubled her contribution. This systematic approach meant she was buying more when prices were low, without having to make emotional decisions in the moment. Another used a calendar-based system, reviewing his portfolio only once per quarter and making adjustments based on predetermined criteria. This protected him from the daily emotional roller coaster that causes so many investors to make poor decisions. So which type performed best? I think you can probably guess, but the numbers are still pretty mind-blowing. Over the 5-year period of our study, trend chasers experienced wild swings in their portfolios, with many ending up in negative territory despite several bull market years. The average trend chaser in our study underperformed the market by 18% over 5 years, with some losing more than half their initial investment. Cautious savers fared somewhat better, but still underperformed. with inflation averaging about 3% annually during our study period and spiking much higher in recent years. Most cautious savers actually lost purchasing power despite seeing small nominal gains. The average cautious saver in our study barely kept pace with inflation, effectively earning 0% real returns over 5 years. Meanwhile, strategic adapters crushed it. By systematically investing through market ups and downs, they not only weathered volatility, but used it to their advantage. The average strategic adapter in our study outperformed the market by 12% over 5 years. That's not just beating the other investor types. That's beating the market itself by a significant margin. Let me put this in dollar terms. If you started with $10,000 at the beginning of our study, the average trend chaser would have about $8,200 at the end of 5 years. The average cautious saver would have about $10,000 in inflation-adjusted dollars, basically breaking even. The average strategic adapter would have about $17,200. That's more than double what the trend chaser ended up with. And remember, they all started with the same amount of money. The only difference was their approach to investing. Now you might be thinking, but what if the strategic adapters just got lucky? What if they happened to be in the right investments at the right time? Great question. That's why we specifically analyzed how each investor type performed during market downturns. And this is where things get really interesting. When markets dropped sharply, trend chasers often panicked and sold at the worst possible moments, locking in their losses. Cautious savers felt validated in their conservative approach and became even more risk-averse, missing the rebounds that typically follow market corrections. But strategic adapters? They stuck to their systems. Some even increased their investments during downturns, buying quality assets at discount prices. Their predetermined rules prevented emotional decision-making exactly when emotions run highest. One strategic adapter named Michael told us, "When the market dropped 30% in 2020, I wasn't happy about it, but I didn't have to think about what to do. I already had my rules in place for that scenario. I increased my contributions and bought more of the same quality investments I already owned, just at better prices." The most shocking finding was that during the major market correction in the middle of our study, strategic adapters not only lost less than the other groups, many of them actually made money. By systematically buying as prices fell and holding through the recovery, they turned what could have been a disaster into an opportunity. Let's be real, this doesn't mean strategic adapters never lost money on individual investments. They did. The difference is they recognized that trying to avoid all losses is not only impossible, but counterproductive to long-term wealth building. Instead of trying to perfectly time the market, which countless studies have shown is virtually impossible, they built systems that worked with market volatility rather than against it. They understood that consistency, not clairvoyance, is the true key to investment success. The costly mistakes of trend chasers, a case study in FOMO. Consistency may be the key to investment success, but what happens when the fear of missing out hijacks your financial decisions? The GameStop and AMC frenzy of 2021 created a perfect storm where investors watched stocks rocket 1,000% plus in days, and the aftermath revealed exactly how costly trend chasing can be. Remember when GameStop's stock price exploded from $20 to a mind-boggling $483 in just a few weeks? Social media platforms like Reddit and Twitter were flooded with screenshots of six-figure gains and stories of retail investors seemingly beating Wall Street at its own game. For our trend chasers, this wasn't just exciting, it was irresistible. What we discovered in our study was truly eye-opening. When we analyzed the trading patterns of trend chasers during the meme stock mania, we found something disturbing. Most of them bought in near the peak. One participant, Jessica, invested nearly 40% of her portfolio in GameStop at $398 per share after seeing posts about the stock going to $1,000. When the price crashed below $40 just weeks later, she lost over $22,000, money she'd been saving for a down payment on her first home. But Jessica wasn't alone. The psychology behind these decisions reveals a troubling pattern. Our research found that trend chasers lost an average of 37% of their portfolio value during market corrections. These weren't just small temporary setbacks. These were substantial financial wounds that would take years to heal. The culprit? A powerful psychological force that drives even smart people to make poor financial decisions. FOMO, the fear of missing out. A study published in 2024 revealed that 61% of investors admitted to making impulsive trades based purely on FOMO. This emotional response creates a dangerous cycle. You see others making money, you jump in late, prices fall, and you end up with significant losses. Take Ryan, another participant in our study. After missing the initial GameStop surge, he vowed not to miss the next big thing. When AMC theaters began trending on investment forums, Ryan invested heavily without researching the company's fundamentals or considering its long-term prospects. "I just knew it was going up," he explained during our interview. Everyone was talking about it hitting $100. Like many others, Ryan bought near the peak and watched in horror as his investment lost more than half its value in days. The tech sector provided another painful lesson for our trend chasers. In late 2021, many jumped into high-flying tech stocks after seeing tremendous gains throughout the year. Companies with sky-high valuations and little profit were trading at extraordinary multiples as investors piled in. Then came 2022, and reality hit hard. The tech-heavy Nasdaq index plummeted by over 30% from its November 2021 peak to its June 2022 low, crushing portfolios built on hype rather than fundamentals. This pattern of emotional investing isn't just about being in the wrong place at the wrong time. It exposes a fundamental misunderstanding about how successful investing actually works. Trend chasers consistently bought high and sold low, exactly the opposite of what creates wealth in the markets. What's particularly fascinating is how confirmation bias played into these decisions. Once trend chasers decided to invest in a hot stock, they selectively consumed information that supported their choice while ignoring red flags. They joined online communities where everyone was bullish, followed social media accounts that hyped their investments, and avoided contrary opinions. Even as warning signs appeared, insider selling, poor earnings reports, or bearish analyst ratings, many doubled down rather than reconsidering their position. Marcus, a marketing executive who participated in our study, described his thought process. "When I saw negative news about stocks I owned, I told myself these critics just didn't understand the opportunity. I found YouTube videos explaining why the stock would still go to the moon, and that made me feel better." That feeling didn't last long. Marcus lost 42% of his portfolio in 2022 alone. A survey conducted in early 2023 revealed that 58% of trend followers reported losses exceeding 20% during market downturns. These weren't just paper losses. Many had to sell at the worst possible time due to financial needs or emotional pressure, locking in substantial permanent losses. What makes this behavior particularly dangerous is that it's self-reinforcing. Trend chasers who got lucky with an early win often attributed it to skill rather than timing, leading them to take even bigger risks with subsequent trades. When these bets failed, they chased losses with increasingly desperate moves, creating a downward spiral that devastated their financial futures. Even more concerning is how accessible and appealing this behavior has become. Modern trading apps have gamified investing with confetti animations for completed trades and easy-to-use interfaces that make complex financial instruments feel like simple games. Social media platforms amplify success stories while failures remain largely invisible, creating a distorted view of reality where everyone seems to be getting rich except you. The strongest predictor of investment losses in our study wasn't education level, income, or even risk tolerance. It was trading frequency. The more frequently investors traded, the worse their returns became. This brings us to the biggest revelation from our research. The number one investment myth keeping most millennials stuck in financial mediocrity is the belief that you need to actively trade to beat the market. This myth has led to increased trading activity, especially among millennials, with 45% reporting they trade more frequently than necessary. Every trade incurs costs, not just in fees, but in taxes, time, energy, and emotional capital. More importantly, frequent trading removes the most powerful force in wealth creation: compound growth over time. When we compared the trading histories of our study participants with their actual returns, the pattern was clear. Those who traded the most consistently lagged the overall market by the widest margins. The best performers weren't those making the cleverest trades. They were those who made thoughtful decisions and then gave their investments time to grow. The tech correction of 2022 revealed another costly mistake trend chasers made repeatedly: sector concentration. Many had over 80% of their portfolios in similar high-growth tech stocks, creating a dangerous lack of diversification. When tech fell out of favor, their entire financial foundation crumbled simultaneously. It wasn't unusual to see portfolios drop 40 to 50% in a matter of months, losses that would take years to recover from even in a favorable market. What's particularly tragic about these losses is that they were entirely avoidable. The market history is filled with examples of speculative manias that ended painfully for late arrivals, from the dot-com bubble to crypto crashes. Yet each generation seems destined to learn this lesson through personal financial pain rather than historical wisdom. While our trend chasers were busy chasing the latest hot stocks, they missed something far more valuable: the consistent growth happening in high-quality companies and broad market indexes. During the same period when many were losing substantial portions of their savings on speculative bets, boring broad market index funds delivered solid returns with far less drama and much lower costs. The financial impact of trend chasing extends beyond immediate losses. Many participants in our study reported longer-term consequences: delayed home ownership, postponed retirement contributions, and increased financial stress. Some even took on credit card debt to fund their trading activities, compounding their financial challenges. The silent killer: how cautious savers are losing money without realizing it. While trend chasers gamble their future away with risky bets, another group is quietly losing their wealth through what they believe is the safest option possible. Did you know your responsible savings account is actually destroying your purchasing power every single day? That $10,000 emergency fund you've proudly maintained for the last 5 years has silently shrunk to just $8,600 in real-world buying power. And the worst part, you never saw a single negative number on your bank statement. Let's talk about the cautious savers from our study. Unlike the trend chasers who chase every hot investment, these individuals prioritize safety above all else. They're the ones who keep substantial portions of their money in savings accounts, CDs, or other guaranteed investments. They check their accounts and feel a sense of security seeing that their balance never goes down. But this perceived safety is actually an illusion. The silent enemy destroying their wealth? Inflation. In 2022, the consumer price index skyrocketed to 6.2%, dramatically eroding the purchasing power of every dollar sitting in low-yield accounts. Even with inflation projected to stabilize around 2.4% by early 2025 according to the Personal Consumption Expenditures Index, the damage continues daily. Here's the brutal math. If your savings account pays the typical 0.05% interest rate while inflation runs at 2.4%, and that's the optimistic projection, you're losing 2.35% of your purchasing power every year. It's like having a hole in your financial bucket that nobody warned you about. Let me introduce you to Rachel, a cautious saver from our study. Rachel diligently saved $500 every month for 5 years, building what she thought was a robust emergency fund of $30,000. She felt proud seeing that number grow steadily in her bank account. But when Rachel finally needed to make a major home repair, she was shocked to discover that the contractor's quotes were significantly higher than she had budgeted for based on research she'd done years earlier. What Rachel failed to account for was that her purchasing power had been silently eroding the entire time. Despite never seeing a negative transaction on her statement, inflation had effectively stolen over $4,200 from her savings. The safety she thought she was building was actually disappearing month by month. This loss is particularly insidious because it happens invisibly. Unlike stock market drops that make headlines and trigger immediate emotional responses, inflation works in the background, gradually reducing what your money can buy without ever changing the number in your account. The psychological profile of cautious savers reveals a fascinating paradox. They're hyper-aware of market risks, the possibility of losing money in stocks or real estate, but completely blind to the guaranteed loss of purchasing power they experience through inflation. In psychological terms, this is called loss aversion bias, where the pain of losing money feels twice as intense as the pleasure of gaining the same amount. Maria, another participant in our study, kept over 70% of her assets in cash equivalents because she was afraid of a market crash. When asked about inflation, she dismissed it as just a few percent and not worth worrying about. But over the 5 years we tracked her finances, Maria's cash holdings lost nearly 14% of their real value. a loss she never perceived because the nominal amount stayed the same. The decision-making process of cautious savers often involves another psychological barrier: choice paralysis. When faced with the overwhelming number of investment options, stocks, bonds, ETFs, mutual funds, real estate, commodities, many simply freeze. It's easier to do nothing than to make what might be the wrong choice. So they default to what feels safest, keeping money in cash. Mark, a 34-year-old technology professional in our study, admitted to having over $100,000 sitting in a checking account earning absolutely nothing for nearly 3 years. When asked why, he explained, "I kept meaning to invest it, but there were so many options, and I was afraid of making a mistake. I figured it was better to wait until I was sure." During those 3 years, his purchasing power diminished by over $10,000 due to inflation. But there's another hidden cost to this excessive caution: opportunity cost. During our study period, while cautious savers were losing 3 to 5% annually in real terms, the broader market offered significant growth opportunities. The S&P 500, despite its volatility, delivered average annual returns that could have doubled their money over the same period. Even more conservative investment approaches could have preserved their purchasing power while providing modest growth. Instead, by choosing what felt like the safest option, they guaranteed themselves a negative real return. The irony is that these investors have fundamentally misunderstood the concept of risk. They equate risk solely with the possibility of losing nominal value, while ignoring the certainty of losing purchasing power. It's like being so afraid of getting wet in a rainstorm that you don't notice you're standing in a slowly rising flood. Some cautious savers do recognize the need for investment, but default to what they consider safe options. Many follow the traditional 60-40 portfolio model, 60% stocks and 40% bonds, which has been financial planning gospel for decades. This approach is touted as providing growth while buffering against market volatility. However, our research revealed a troubling truth. The traditional 60-40 portfolio model is failing in today's economic environment. Why? Because it doesn't adequately account for persistent inflation and changing market dynamics. Bonds, which make up that crucial 40% portion, have historically been a reliable counterbalance to stock market volatility. But in an inflationary environment, bonds often underperform, leaving these balanced portfolios vulnerable on both fronts. Jennifer, a participant who followed this traditional model, saw her portfolio significantly underperform during our study period. While she avoided the dramatic losses of trend chasers, her safe approach still failed to keep pace with inflation after accounting for management fees and taxes. She was effectively losing money in slow motion. The most successful investors in our study took a different approach. Rather than avoiding risk entirely or relying on outdated portfolio models, they embraced alternative investments and emerging market equities that showed potential for higher returns compared to traditional portfolios. They recognized that in an inflationary environment, certain assets perform better than others, and they adapted accordingly. Let's be clear. Keeping some money in cash for emergencies and short-term needs is absolutely necessary. Having 3 to 6 months of expenses in a high-yield savings account provides essential financial security. But anything beyond that is likely losing value every day it sits there. The tragedy of cautious savers isn't that they value security. That's a perfectly reasonable priority. The tragedy is that their approach doesn't actually provide the security they think it does. By focusing exclusively on nominal value preservation, they guarantee themselves real value destruction. Think about retirement for a moment. If you're saving with the goal of maintaining your lifestyle 20 or 30 years from now, inflation isn't just a minor inconvenience. It's potentially catastrophic. Even at a modest 2.4% inflation rate, prices will double in about 30 years. That means $1 million today will have the purchasing power of just $500,000 3 decades from now. This reality is particularly harsh for younger savers. The longer your time horizon, the more devastating the effects of inflation become. Someone in their 20s or 30s keeping substantial assets in cash isn't just missing out on growth. They're actively sabotaging their future financial security. So what's the solution? It doesn't require becoming a trend chaser and taking excessive risks. It simply means understanding that risk is a multifaceted concept that includes inflation. The Strategic Adapters Playbook, Systems over Speculation. While most investors obsess over picking winning stocks or timing the market perfectly, our research revealed something truly eye-opening. The most successful investors weren't defined by what they invested in, but how they structured their approach. The strategic adapters in our study didn't just make better decisions. They built better systems that removed the need for perfect decisions in the first place. Think about it this way. What if investing successfully isn't about making brilliant moves every time the market shifts, but instead about creating a framework so robust it works even when you're not watching? That's exactly what separated our strategic adapters from everyone else. When we looked closer at their approach, we found something fascinating. While trend chasers were frantically checking their phones for the latest hot tip and cautious savers were paralyzed by fear, strategic adapters were calmly implementing their predetermined investment plans. They viewed investing not as a series of individual decisions, but as an integrated system designed to function regardless of market conditions. Their core principle was beautifully simple yet powerful. Your investment system should work whether you're paying attention or not. This mindset shift changed everything. Instead of trying to outsmart the market, which is nearly impossible, they built frameworks that embraced market realities and worked with them. Let's break down the 3 pillars that made their approach so effective. First was strategic asset allocation. Not just randomly picking investments, but thoughtfully designing a portfolio with specific purposes for each holding. Second was psychological discipline, creating guardrails against emotional decision-making. And third was consistent automation, removing human error from the equation as much as possible. The psychological pillar was particularly important. Strategic adapters understood that their own minds could be their worst enemy. Unlike other investor types who reacted emotionally to market swings, they established clear rules for buying and selling assets before they needed to make those decisions. One strategic adapter in our study created a personal investment constitution that specified exactly what actions to take when certain market conditions occurred. For example, Sandra, a 32-year-old software developer, programmed her investment system to automatically increase her contributions by 10% whenever the market dropped more than 15% from its high. Rather than panicking during downturns like others, her system recognized these moments as buying opportunities, acquiring quality assets at discount prices. Their rule-based approach wasn't just theoretical. Our data showed that these clear criteria for buying and selling assets consistently outperformed more intuitive approaches. By removing emotion from the equation, strategic adapters maintained their discipline when others were losing theirs. This systematic approach extended to portfolio design as well. Rather than chasing returns in individual sectors, they created diversified portfolios that balanced growth potential with downside protection. Their asset allocation wasn't static either. It evolved strategically based on life stages and market conditions, not reactionary emotions. Jason, a 29-year-old teacher in our study, implemented a portfolio strategy that included built-in shock absorbers, investments that typically moved in opposite directions during market stress. This didn't just protect his wealth during downturns. It gave him the confidence to stay invested when others were fleeing the market. But perhaps the most powerful advantage of the strategic adapters was how they leveraged technology and automation. Rather than trying to time the market, which countless studies have shown is nearly impossible, they set up automated systems that invested regularly regardless of market conditions. The data was clear: dollar-cost averaging, consistently investing the same amount at regular intervals, proved to be remarkably effective during volatile markets. This approach spread investments over time, reducing the impact of market fluctuations on their overall portfolios. When markets plunged, their automatic investments purchased more shares at lower prices without requiring any emotional fortitude or decision-making. Consider Emily, who set up automatic investments of $400 every 2 weeks into her diversified portfolio. During the 2022 market downturn, while many investors panicked and sold at massive losses, her system continued purchasing assets at decreasing prices. When the market eventually recovered, these discounted purchases generated substantial returns, significantly outpacing investors who tried to time the bottom. Many strategic adapters in our study utilized robo-advisors to further enhance their systematic approach. These platforms use sophisticated algorithms to optimize asset allocation based on individual risk tolerance and financial goals. The personalized portfolio management provided by these tools maintained discipline and reduced emotional decision-making, two key factors in investment success. What's particularly interesting is how the integration of technology supported their investment philosophy. AI-powered financial tools didn't just execute trades, they provided real-time insights, tracked spending patterns, and made portfolio adjustments based on changing market conditions, all while the investors focused on their daily lives. The contrast with other investor types was stark. While trend chasers spent hours obsessively checking prices and cautious savers worried about potential losses, strategic adapters had peace of mind knowing their systems were working in the background. They weren't glued to financial news or constantly checking their portfolio values. They trusted their systems to function effectively without constant supervision. But wasn't this approach too simplistic? Surprisingly, no. Studies indicated that these systematic investing approaches, which removed emotional biases from decision-making, consistently led to improved returns compared to traditional methods relying on market timing or stock picking. In fact, when we analyze performance during periods of extreme market volatility, strategic adapters not only preserved more capital than other investor types, but actually accelerated their wealth creation. By having pre-established guidelines for increasing contributions during market downturns, they purchased more assets precisely when prices were lowest. Take Michael, who automated an additional $200 monthly contribution whenever the market declined by 10% or more. This simple rule meant he invested more heavily during the March 2020 COVID crash and the 2022 tech correction, two periods that later produced substantial returns when markets recovered. This approach didn't require complex trading strategies or expensive financial advisors. It simply required establishing clear rules, embracing automation, and recognizing that consistency beats timing. By setting up automatic transfers from checking accounts to investment platforms, strategic adapters eliminated the need for willpower or discipline with each investment decision. But what was the most powerful automation system that helped strategic adapters stay consistent even during market panic? Their secret weapon was surprisingly simple: regular, automatic investments regardless of market conditions, creating a powerful dollar-cost averaging effect. When markets crashed, their automatic investments purchased more shares at lower prices. When markets soared, those same automatic investments continued building their positions. Consider Sophia, who automated $300 weekly investments into a diversified portfolio. During the turbulent markets of 2020 to 2022, her average purchase price across all investments was significantly lower than investors who tried to time their entries. This simple approach, essentially investing on autopilot, outperformed 83% of the active investors in our study. The beauty of this system was its simplicity. No complex trading strategies. No need for perfect timing. Just consistent execution of a well-designed plan. Strategic adapters weren't trying to predict the future. They were building systems that worked regardless of what the future held. Building your strategic portfolio, the asset allocation that actually works. Systems are only as good as what you put into them. The strategic adapters didn't just automate their investments. They carefully engineered exactly what went into their portfolios. Did you know that the top performers in our study allocated 30% of their investments to assets most people completely overlook? This unconventional approach helped them generate returns that outpaced traditional portfolios by a shocking margin. Let's break down what these strategic adapters were actually buying. Their portfolios looked radically different from the standard 60-40 stocks and bonds mix that your typical financial advisor probably recommends. Instead, they built a four-part allocation strategy that balanced growth, income, and protection against market volatility. First, they established a solid foundation by putting 60% of their money into core holdings. These weren't just any random index funds, though. They specifically chose low-cost funds tracking the total market, small-cap value stocks, and international markets. This diversified base gave them broad market exposure while keeping fees incredibly low, sometimes less than 0.1% annually compared to the 1 to 2% many actively managed funds charge. But here's where things get interesting. While most investors stop at stocks and bonds, strategic adapters allocated 20% of their portfolios to real estate investments. They didn't need to buy physical properties either. They used a combination of real estate, investment trusts, REITs, and newer crowdfunding platforms that let them invest in specific projects with as little as $10. Why real estate, you might ask? The data speaks for itself. Looking ahead to 2025, U.S. value-added real estate is projected to generate annualized returns of 10.1%. That's not just impressive, it's market-beating by a substantial margin. This performance is largely driven by something many of us experience firsthand: America's persistent housing shortage, particularly in multifamily and workforce housing. The third piece of their allocation puzzle was equally surprising. They dedicated 10% to emerging markets. While most investors shy away from these supposedly risky investments, strategic adapters recognize the enormous growth potential in countries experiencing rapid urbanization and expanding middle-class populations. They weren't just blindly investing in any emerging market fund, though. They specifically targeted sectors poised for explosive growth, like renewable energy projects in Latin America and Asia. These regions are attracting massive investments as the global energy transition accelerates, creating opportunities for early investors with the foresight to position themselves accordingly. The final 10% of their portfolios went into alternative investments, assets that have little correlation to traditional markets. These included everything from specialized commodity funds to private equity opportunities. The key advantage here wasn't necessarily higher returns, though those often materialized, but rather how these investments performed during market turbulence. When stocks tanked, many of these alternatives held steady or even increased in value, providing crucial stability during volatile periods. What makes this four-part allocation so effective? It's all about balancing different types of risk. Traditional portfolios concentrate almost exclusively on market risk, the ups and downs of stock prices. But strategic adapters distributed their investments across multiple risk categories: market risk, inflation risk, liquidity risk, and correlation risk. This approach proved particularly valuable during market corrections. When stocks plummeted, their real estate and alternative investments often remained stable or declined less dramatically. This reduced the overall volatility of their portfolios and, more importantly, prevented them from making panic-driven decisions at market bottoms. Let's zoom in on that real estate component, because it's delivering some truly remarkable results. While residential real estate might seem boring compared to flashy tech stocks, it's quietly generating returns that would make most day traders jealous. That projected 10.1% annualized return isn't just a random number. It's backed by fundamental economic forces. America's housing shortage isn't going away anytime soon. We simply aren't building enough homes to meet demand, creating persistent upward pressure on both home prices and rents. Strategic adapters capitalized on this trend by investing in residential REITs focused on multifamily properties and workforce housing, exactly the segments experiencing the most severe supply constraints. Even better, REITs are expected to perform exceptionally well as interest rates decline. After years of high rates putting pressure on real estate valuations, falling rates will likely trigger a substantial rebound. Plus, REITs offer significant tax advantages, making them particularly attractive for income-seeking investors. What's perhaps most interesting is that this approach isn't just limited to older, established investors. We're seeing a generational shift in investment preferences. Millennials are now allocating approximately 17% of their portfolios to alternative assets, a dramatic departure from their parents' generation, who typically stuck with basic stocks and bonds. This willingness to explore beyond traditional asset classes reflects a broader understanding that conventional investment wisdom might not be sufficient in today's economic environment. Young investors have lived through multiple market crashes, persistent inflation, and economic uncertainty, experiences that have made them more receptive to diversified approaches. Another key advantage of the strategic adapters allocation model was its attention to emerging markets. While most investors limit their international exposure to developed economies like Europe and Japan, the real growth story is happening elsewhere. By dedicating 10% specifically to emerging economies, they position themselves to benefit from demographic trends that will play out over decades, not just quarters. These investors particularly focused on technology and renewable energy sectors within emerging markets. Countries like India, Brazil, and Vietnam are experiencing rapid technology adoption, often leapfrogging older infrastructure entirely. Meanwhile, renewable energy installations are growing exponentially. In these regions, creating investment opportunities with substantial long-term potential. What's remarkable about this entire allocation approach is its resilience across different market environments. During the bull market of 2020 to 2021, the growth components performed exceptionally well. When inflation spiked in 2022, their real estate and alternative investments provided crucial protection. This all-weather quality meant they never needed to make dramatic portfolio shifts based on economic predictions or market timing. Their diversification strategy worked regardless of conditions. I know what you're thinking. This sounds great, but how complicated is it to implement? The surprising answer is, not very. Strategic adapters didn't use exotic investment vehicles or complex trading strategies. They primarily utilized widely available ETFs, mutual funds, and investment platforms accessible to anyone with a brokerage account. The real estate portion, for example, could be as simple as investing in a broadly diversified REIT index fund. For those wanting more targeted exposure, several crowdfunding platforms now offer access to specific real estate projects with investment minimums as low as $10. Similarly, emerging market exposure can be gained through low-cost ETFs that focus on specific regions or sectors. One strategic adapter we studied, Melissa, described her approach as set it and forget it with a purpose. She carefully researched and selected investments aligned with her 4-part allocation strategy, then automated her contributions. Each paycheck, money flowed automatically into her various investments according to her predetermined percentages. This removed the temptation to time the market or make emotional decisions during volatility. The beauty of this system lies in its simplicity and effectiveness. By thoughtfully distributing investments across different asset classes with distinct risk profiles, strategic adapters created portfolios that could weather almost any economic storm. They didn't need to predict the future. They just needed to build a resilient system that could thrive in a range of possible futures. The Psychology Playbook: How Strategic Adapters Beat Their Own Brains. Your investment strategy might be solid on paper, but have you ever wondered why you still struggle to see the returns you expect? The truth is, even the most brilliant investment plan is completely worthless if your own psychology sabotages it at every turn. Strategic adapters didn't just build resilient portfolios. They built resilient mindsets using specific techniques to overcome the psychological traps that cause most investors to make costly mistakes without even realizing it. Would you believe that 72% of investors tend to sell their investments at the worst possible time? That's right. Nearly 3/4 of people panic sell during market downturns, locking in losses instead of staying the course. This isn't because they're financially illiterate or have poor portfolios. It's because they're human. Our brains evolved to help us survive immediate physical threats, not to make rational decisions about abstract financial concepts during periods of uncertainty. The fear response that served our ancestors well when escaping predators now triggers a flight response when we see our portfolio value dropping, leading to impulsive selling at precisely the wrong moment. Strategic adapters recognize this fundamental flaw in human psychology and built systems specifically designed to counteract it. Rather than fighting against their natural emotional responses, they created what behavioral economists call emotional circuit breakers, predetermined rules and practices that prevent impulsive decisions during market volatility. One of the most powerful tools in their psychological arsenal was something surprisingly simple: investment journaling. Unlike regular investors who only track what they bought and at what price, strategic adapters documented their complete thought process. Their investment journals included not just transaction details, but also their reasoning, market conditions, and emotional state at the time of each decision. Emma, a 34-year-old marketing executive, reviewed her investment journal every quarter. "Looking back at my rationale for previous investments has been eye-opening," she explained. "During one market correction, I was about to sell some positions out of fear. But when I reviewed my journal, I saw that my original investment thesis was still valid despite the temporary market conditions. That single insight saved me thousands." This practice created accountability and perspective. By documenting their thinking, strategic adapters could later evaluate not just whether an investment performed well, but whether their decision-making process was sound, allowing them to improve their approach over time rather than repeating the same psychological mistakes. Another powerful technique they employed was pre-commitment, deciding in advance exactly how they would respond to different market scenarios. Instead of waiting for market crashes to figure out a response when emotions would be running highest, they created detailed action plans for various situations. David, a 28-year-old software engineer, had a written plan stipulating that if the market dropped 20%, he would automatically increase his monthly contributions by 15%. When the market plummeted in early 2020, he didn't need to make an emotional decision. He simply executed his pre-planned strategy, buying quality assets at discount prices while others were panic selling. This approach eliminated the need for in-the-moment willpower, which psychological research shows is a finite resource that gets depleted during stressful situations. By having clear rules established during calmer times, strategic adapters essentially took the emotional decision-making element out of the equation. Perhaps one of their most counterintuitive but effective strategies was deliberately limiting how often they checked their portfolios. While trend chasers obsessively monitored their investments multiple times daily, strategic adapters intentionally created distance between themselves and minute-by-minute market movements. Studies have consistently shown that frequent portfolio checking leads to poorer investment performance. The more investors monitor short-term fluctuations, the more likely they are to overreact to normal market volatility. Strategic adapters recognized this psychological trap and structured their routines to avoid it. Lisa, a 31-year-old healthcare professional, scheduled just 2 portfolio review sessions annually. "The less I look, the better my returns," she noted. During the 2022 correction, when most of my colleagues were freaking out checking their accounts daily, I stuck to my semi-annual review schedule. The market had mostly recovered by my next scheduled check-in, so I avoided the emotional roller coaster entirely. This practice of limiting exposure to market volatility proved especially valuable during turbulent periods. Strategic adapters who checked their portfolios less frequently reported significantly lower stress levels and were far less likely to make impulsive decisions that undermined their long-term strategy. They also implemented systematic approaches like dollar-cost averaging to remove the psychological burden of trying to time the market. By automatically investing fixed amounts at regular intervals regardless of market conditions, they eliminated the anxiety of deciding when to invest. This strategy not only produced better returns over time, but also reduced the cognitive and emotional load of investing. But perhaps the most powerful psychological technique in their arsenal addressed what behavioral economists call recency bias. Our tendency to give disproportionate weight to recent events and assume they'll continue indefinitely. Recency bias is particularly dangerous during market downturns. When stocks are falling, our brains naturally project that trajectory forward, making it feel like they'll keep falling forever. This cognitive distortion leads many investors to sell at the absolute worst moment, locking in losses just before markets typically begin to recover. To combat recency bias, strategic adapters created personalized perspective tools. Jordan, a 36-year-old project manager, kept a market history chart prominently displayed next to his computer, showing how major market drops throughout history were followed by recoveries. When everything was crashing in 2022, I'd look at that chart and remind myself that this had happened before and would eventually reverse, he explained. Others maintained opportunity funds, cash reserves specifically earmarked for investing during market downturns. By reframing market drops as buying opportunities rather than disasters, they transformed their emotional response from fear to calculated enthusiasm. The psychological discipline of strategic adapters extended beyond just avoiding mistakes to actively cultivating beneficial mental habits. Many practiced what psychologists call cognitive reframing, intentionally shifting how they interpreted market events. While average investors might see a 15% market drop as a crash or crisis, strategic adapters trained themselves to view it as a discount opportunity or expected market behavior. This subtle but powerful shift in perspective changed their emotional response and subsequent actions. Some strategic adapters even incorporated meditation and mindfulness practices specifically focused on financial decision-making. Research has shown that mindfulness can help reduce the impact of cognitive biases and emotional reactivity, leading to more rational financial choices. By developing greater awareness of their emotional states, these investors could recognize when fear or greed was influencing their thinking and take steps to counteract it. The results spoke for themselves. During major market corrections, when most investors were selling in panic, strategic adapters were either holding steady or strategically buying more. This psychological resilience allowed them to capitalize on opportunities that others missed due to emotional reactions. The investment world often focuses on finding the perfect stock or timing the market just right. But strategic adapters recognized that mastering their own psychology was actually the more critical factor in their success. They understood that their biggest investment threat wasn't market volatility. Starting small, how strategic adapters built wealth with limited capital. Beyond conquering their psychological barriers, strategic adapters tackled another major obstacle that keeps millions trapped in financial limbo: the belief that you need thousands to start investing. Think your modest paycheck means you can't build wealth? The data reveals an entirely different reality. Let me introduce you to Alex, a 26-year-old barista from our study who started with just $50 per week, about what many people spend on takeout food. Despite his modest income, Alex committed to setting aside this small amount every Friday when he got paid. "I honestly didn't think $50 would make any difference," he admitted. "But I figured something was better than nothing." What happened next surprised even our researchers. Within 5 years, Alex's consistent $50 weekly contributions had grown to over $16,000. This wasn't because he picked winning stocks or timed the market perfectly. It was simply the power of consistency combined with compound growth at average market returns of around 7% annually. But Alex wasn't alone. Throughout our study, we noticed a fascinating pattern. Many strategic adapters who started with minimal capital actually outperformed investors who began with much larger sums. How is this possible? The answer lies in their approach, not their account size. Take Mia, for example. As a recent graduate with student loans, she couldn't afford to invest large amounts at once. Instead, she embraced micro-investing through platforms that allowed her to start with as little as $1. "I started investing my spare change through an app that rounded up my purchases," she explained. "It felt painless since I barely noticed the money leaving my account." What made these small start investors successful wasn't just that they began, it was how they maximized every dollar. They understood a crucial concept that most people miss. Percentage returns matter more than absolute dollar amounts when you're starting out. Think about it this way. If you invest $50 and it grows by 20%, you've made $10. That might not sound impressive, but the percentage growth is what compounds over time. Those same investment skills applied to larger amounts later in your journey create exponentially bigger results. The strategic adapters in our study leveraged several key strategies that anyone can use to turn small contributions into significant wealth. First, they embraced fractional share investing. Before platforms offered this option, you needed enough money to purchase whole shares of stock. If Amazon traded at $3,000 per share, you needed at least that much to invest. But strategic adapters used services that allowed them to purchase portions of expensive stocks with whatever amount they had available. "I couldn't afford a full share of Apple or Tesla," explained Jamie, a 28-year-old teacher. "But with fractional shares, I could invest $20 in each company every month. It made diversification possible even with my small budget." This approach solved a major problem for small investors: diversification. Rather than putting all their limited funds into a single affordable stock, strategic adapters built surprisingly diverse portfolios by owning small pieces of many different companies. Platforms like SoFi and Robinhood became essential tools in their approach, offering features specifically designed for small capital investors. These services eliminated minimum investment requirements and dramatically reduced fees that would otherwise eat up small contributions. The second strategy they mastered was dollar-cost averaging, investing fixed amounts at regular intervals regardless of market conditions. This approach naturally led them to buy more shares when prices were low and fewer when prices were high, effectively lowering their average cost per share over time. "I set up automatic transfers of $75 every paycheck," said Tyler, a 31-year-old graphic designer. "Some months the market was up, others it was down, but I never had to think about timing it perfectly. The system just worked in the background." This consistency proved especially valuable during market downturns. While many investors panic sold or froze, strategic adapters continued their regular contributions, essentially buying assets on sale. Their automatic investment systems removed emotion from the equation. The third winning strategy was prioritizing high-impact accounts first. Many small investors make the mistake of spreading their limited capital across too many investments. Strategic adapters instead focused on maximizing employer matches in retirement accounts before expanding elsewhere. My company matched 50% of my 401k contributions up to 6% of my salary, recalled Nicole, a 29-year-old sales representative. That's an immediate 50% return on my money. No other investment could guarantee that, so I made sure to capture that free money first before investing anywhere else. This approach turned their modest contributions into much larger sums through what was essentially free money from their employers. Only after maximizing these matching opportunities did they branch out to other investment vehicles. Perhaps most importantly, strategic adapters automated everything. They understood that willpower is a limited resource, and the best system is one that requires no ongoing decisions. By setting up scheduled transfers from their checking accounts directly to investment platforms, they removed the temptation to spend that money elsewhere. This automation had another surprising benefit. It made market volatility less stressful. I honestly didn't even notice when the market dropped 20% in 2022, admitted Carlos, a 33-year-old IT specialist. My automatic investments just kept going, and I wasn't checking my balance every day. When I finally looked months later, I was shocked to see how much those discount purchases had already bounced back. Many strategic adapters in our study also utilized robo-advisors, which create and manage diversified portfolios based on your risk tolerance and time horizon. With minimum investments often as low as $5, these platforms made professional portfolio management accessible to even the smallest investors. I didn't know anything about asset allocation when I started, said Lynn, a 27-year-old nurse. The robo-advisor asked me simple questions about my goals and risk tolerance, then built a portfolio that was far more sophisticated than anything I could have created on my own. One of the most powerful strategies employed by small capital strategic adapters was visualizing the end result rather than focusing on the small starting point. They understood the math of compounding and kept their eyes on where their investments would be in 5, 10, or 20 years. This long-term perspective prevented them from getting discouraged by the initially modest growth of their investments. While $50 weekly might only grow to $2,700 in the first year, the compounding effect accelerates dramatically over time, reaching $16,000 by year 5 and potentially over $85,000 by year 15 with consistent contributions and average returns. What's particularly inspiring about these successful small start investors is that they didn't wait for some mythical perfect time to begin. They recognized that the most important factor in investment success isn't market timing or having a large lump sum. It's simply getting started and staying consistent. I used to think I needed at least $10,000 to start investing seriously, shared Marcus, a 30-year-old customer service representative. Waiting to save that much meant I wasted years of potential growth. Once I realized I could start with just $25 a week, everything changed. 5 years later, that decision has completely transformed my financial future. The pattern was clear across our study. Strategic adapters who started with modest amounts but remained consistent ultimately accumulated more wealth than those who waited to save larger amounts before investing, or those who invested sporadically in larger chunks. Their success proves that investment returns have far more to do with behavior, consistency, and time in the market than with the initial amount invested. Many amassed 5-figure portfolios from what seemed like insignificant weekly contributions that most people would dismiss as not worth bothering with. The tech stack, tools and platforms of successful investors. Those 5-figure portfolios weren't built using the sophisticated trading platforms you might expect. In fact, our research uncovered that the most financially successful millennials aren't using fancy charting tools or premium stock screeners at all. They're leveraging a completely different approach to technology that gave them a massive edge without the complexity. When we looked closely at the tech stack of strategic adapters, one pattern emerged immediately. Simplicity trumps sophistication every time. While trend chasers often subscribe to premium trading platforms with complicated technical analysis tools, strategic adapters focused on technology that reinforced their systematic approach and removed emotion from the equation. I always assumed I needed professional-grade software to be a serious investor, admitted Tara, a 32-year-old strategic adapter who outperformed 91% of our study participants. But the tools that actually moved the needle for me were shockingly basic. Let's break down the three-tier technology approach that strategic adapters consistently use to automate and optimize their investments. Tier 1, automation tools. The foundation of every strategic adapter's tech stack was automation. Rather than constantly monitoring markets and making manual trades, they set up systems that invested automatically according to their predetermined plans. The biggest revelation? Robo-advisors emerged as the cornerstone of their automation strategy. Platforms like Wealthfront and Betterment charge just 0.25% in management fees, a fraction of the 1% or more that traditional financial advisors demand. For someone investing $50,000, that's a savings of $375 annually that stays in their portfolio, compounding over time. But the benefits went beyond cost savings. These platforms handle the heavy lifting of portfolio management through features like automatic rebalancing and tax loss harvesting, sophisticated strategies that would require significant time and expertise to implement manually. My robo-advisor handles rebalancing automatically when my asset allocation drifts too far from my targets, explained Kevin, a 29-year-old engineer who grew his portfolio by 68% during our study period. It also harvests tax losses during market downturns, which saved me over $1,200 in taxes last year alone. This hands-off approach allowed strategic adapters to maintain optimal portfolio allocation without succumbing to emotional decision-making during market volatility. Their investments continued working efficiently in the background while they focused on their careers and lives. Tier 2, research resources. While trend chasers often paid hundreds or even thousands of dollars annually for premium research services, strategic adapters took a completely different approach to gathering investment information. They gravitated toward free research tools that performed comparably to paid services. Platforms like Mint and PocketGuard helped them track spending and budgeting without subscription fees, making financial management more accessible and sustainable long-term. I used to pay $29.99 monthly for a premium stock research service, shared Rachel, whose portfolio grew steadily at 9.3% annually throughout our study. Now I use free tools that give me 90% of the same information without the recurring cost eating into my returns. Instead of chasing hot stock tips, strategic adapters focus their research on understanding broad market trends, asset allocation strategies, and long-term economic factors. They avoided the noise of daily market movements and concentrated on information that informed their systematic approach. What's fascinating is how this approach saved both money and time. While trend chasers spent an average of 7.3 hours weekly consuming financial content and researching potential trades, strategic adapters averaged just 1.2 hours weekly on investment research, mostly focused on quarterly portfolio reviews and occasional adjustments to their automation systems. Tier 3, integration capabilities. The third technological advantage strategic adapters leveraged was seamless integration between different financial tools. Rather than using disconnected apps and platforms, they created ecosystems where their financial tools worked together. The integration capabilities between personal finance apps and investment platforms have become increasingly sophisticated, allowing users to manage their entire financial ecosystem from a single interface. This includes linking bank accounts, investment accounts, and budgeting tools for a comprehensive view of their finances. Having everything connected gives me a complete picture of my financial health, noted Maya, a 34-year-old marketing specialist whose consistent approach yielded 11.2% annual returns. I can see how my spending affects my investment contributions, track my progress toward financial goals, and make adjustments from a single dashboard. This holistic view helps strategic adapters maintain perspective during market volatility. When stocks tumbled in 2022, those with integrated financial systems could see that their overall financial position remained strong despite temporary market declines. The tech integration also created accountability. When investment apps were connected to budgeting tools, strategic adapters could immediately see the impact of their spending choices on their investment progress, reinforcing the discipline that characterized their approach. But here's the most surprising revelation from our technology analysis. The tool strategic adapters ranked as most valuable wasn't a specialized investment platform at all. The secret weapon, banking automation. When asked to identify their most valuable financial technology, 87% of strategic adapters pointed to something surprisingly mundane: the automatic transfer feature from their regular bank accounts. While this might seem disappointingly simple, it proved to be the technological foundation of their investment success. Strategic adapters set up recurring transfers from checking to investment accounts, creating a system that removed the need for ongoing discipline and decision-making. I set up an automatic transfer of $200 every Friday from my checking account to my investment account, explained Elijah, whose portfolio grew from $8,000 to over $42,000 during our 5-year study. It doesn't sound fancy, but that's simple. Automation is the reason I've been able to stick with my investment plan through every market condition. This automatic transfer system solved the biggest problem most investors face: consistency. By removing the need to manually initiate transfers, strategic adapters eliminated the opportunity for second-guessing or procrastination. Their investment contributions continued regardless of market conditions, news headlines, or emotional reactions. The power of this approach became especially apparent during market downturns. While many investors stopped contributing or even withdrew funds when markets fell, strategic adapters' automatic transfers continued working silently in the background, allowing them to acquire assets at discount prices. Many banks now provide sophisticated automatic transfer systems that allow users to set up recurring transfers from checking to savings or investment accounts based on various triggers. Not just calendar dates, but also account balances, spending patterns, and other variables. This automation reduces the likelihood of missed contributions and helps maintain financial discipline. AI assistance, the emerging tool. Beyond the 3-tier approach in banking automation, our research identified an emerging technology that strategic investors are increasingly adopting: AI-powered financial assistance. AI chatbots are becoming valuable tools for personal finance management, offering real-time insights and automated budgeting assistance. These chatbots can categorize expenses, track spending, and provide personalized financial advice based on user behavior. My AI financial assistant alerts me when my spending in certain categories exceeds my budget, shared Alex, a 27-year-old who maintained an impressive 13.1% annual return throughout our study. It also identifies potential investment opportunities based on my goals and risk tolerance. It's like having a financial planner in my pocket. While this technology is still evolving, early adopters reported significant benefits in maintaining financial discipline and making informed investment decisions. The personalized nature of AI recommendations helped them customize their approach based on their unique financial situations. The technology gap, why it matters. Perhaps the most striking finding from our technology analysis was the stark contrast between the tools used by successful and unsuccessful investors. While strategic adapters embraced simple, automated systems, trend chasers gravitated toward complex trading platforms with sophisticated charting tools and real-time data feeds. These complex platforms often gave trend chasers the illusion of control and expertise. The availability of advanced technical indicators and real-time market data created a sense that they could predict short-term market movements, a belief that consistently led to poor timing decisions and excessive trading. I spent so much time analyzing charts and setting up complex trading algorithms, admitted former trend chaser Marco, who has since adopted a more systematic approach. All that technology actually encouraged my worst investing habits: frequent trading, overconfidence, and reacting to short-term market noise. The technology gap between investor types went beyond the tools themselves to how they were used. Strategic adapters used technology to remove themselves from the equation, creating systems that functioned independently of their daily involvement. In contrast, trend chasers used technology to increase their engagement, leading to overactive portfolio management and emotion-driven decisions. This fundamental difference in approach to technology had enormous implications for investment outcomes. The simplicity and automation that characterized strategic adapters' tech stack supported their disciplined, long-term approach, while the complexity and engagement of trend chasers' your 30-day action plan, becoming a strategic adapter. While the right technology removes friction from your investing journey, technology alone can't transform you into a strategic adapter. What separates those who struggle from those who succeed is having a practical, step-by-step implementation plan. The next 30 days could completely revolutionize your financial future. If you follow the exact blueprint our most successful investors used to break free from costly investing patterns. I know what you're thinking. Another 30-day plan that promises the world. But this isn't about overnight riches or complex strategies. It's about building an investment system that works whether you're watching the market or not. Our strategic adapters didn't just stumble into success. They followed a specific roadmap that anyone can implement, regardless of their starting capital. The greatest challenge isn't understanding what to do. It's actually doing it consistently. Breaking ingrained financial habits is tough, especially when market volatility triggers our emotional responses. But consider the alternative, continuing down the same path that's keeping you from building real wealth. The cost of not changing your approach could be hundreds of thousands in lost opportunities over your lifetime. Let's break down this transformation into 3 manageable weeks. Week 1 is all about assessment and automation. Start by conducting an honest investment audit. Look at your current investments and track their performance against your goals. Are your assets underperforming? Do they align with your financial objectives? This process helps identify which investor persona you currently resemble. Are you chasing trends, hiding in savings accounts, or somewhere in between? Next, set up your automation system. This is the backbone of the strategic adapter approach. Connect your checking account to your investment accounts with automatic transfers on regular intervals, whether it's weekly, bi-weekly, or monthly. The key is consistency. By automating your finances, you'll prevent late payments, reduce human error, and ensure you're investing regularly regardless of market conditions. Creating a budget using the 50/30/20 rule can be incredibly helpful here. Allocate 50% of your income for needs, 30% for wants, and 20% for savings and investments. This simple framework makes sure you're consistently directing money toward your financial future without feeling deprived in the present. Week 2 focuses on building your foundation and creating rules. Now that your automation is set up, it's time to build your core portfolio. For most people, this means low-cost index funds or ETFs that offer broad market exposure with minimal fees. These investment vehicles provide instant diversification and are perfect for long-term growth, especially for beginners. Your investment selection should reflect your personal risk tolerance and time horizon. Someone in their 20s might have a higher allocation to equities, while someone nearing retirement might want more conservative investments. The beauty of index funds is their simplicity. They remove the pressure of picking individual winners. This week, you'll also create what our strategic adapters called their investment constitution, a written document that outlines your personal investment rules. This isn't some complicated legal document. It's simply a set of guidelines that dictate when you'll buy, sell, or hold investments. For example, I will increase my monthly contributions by 10% whenever the market drops more than 15%. Or, I will not sell any positions during market corrections unless fundamentals have changed. This constitution serves as a defense against emotional decision-making. When markets get turbulent, you won't be making decisions on the fly. You'll simply follow your pre-established rules, just like our most successful investors did. Week 3 is when you enhance your portfolio and protect your psychology. With your core investments and rules in place, it's time to add strategic diversifiers to your portfolio. These might include short-term treasury bonds or gold, assets that typically don't move in lockstep with equities and can provide stability during market downturns. This is also when you'll implement what we call psychological circuit breakers, mechanisms that prevent you from sabotaging your own success. Start by establishing an emergency fund if you don't already have one. This should cover 3 to 6 months of living expenses, providing a financial cushion that allows for more aggressive investing strategies without fear of immediate financial distress. Set up an investment journal to track not just what you're buying, but why you're buying it. Document your reasoning, market conditions, and even your emotional state when making decisions. This creates accountability and helps identify patterns in your decision-making. Find an accountability partner, someone you trust who can help you. Stick to your plan when emotions run high. This could be a friend, family member, or financial advisor who understands your goals and can provide objective feedback when you're tempted to make impulsive moves. Pre-commitment strategies are another powerful tool. Decide in advance how you'll respond to specific market scenarios. For instance, you might commit to increasing your investments by a set percentage if the market drops by 20%. Having these decisions made in advance removes the burden of choosing during emotionally charged moments. One of the most powerful portfolio adjustments you can make during this week is adding uncorrelated assets. These investments don't necessarily move in the same direction as the broader market, offering protection during turbulent times. While stocks might plummet during a recession, assets like treasury bonds might hold steady or even increase in value. Consider implementing a systematic investment plan, SIP, in mutual funds. This approach allows you to contribute a fixed amount regularly, helping average out the cost of investments over time and mitigating market volatility. It's a proven strategy that removes the pressure of timing the market perfectly. By the end of these 3 weeks, you'll have built not just a portfolio, but a complete investment system that runs with minimal intervention. Your automated transfers will ensure consistent contributions. Your investment constitution will guide decision-making during market volatility, and your psychological circuit breakers will protect you from your own worst impulses. But what happens after the initial 30 days? Week 4 and beyond is about maintenance and refinement. Schedule regular portfolio reviews, not daily or weekly, but quarterly or semi-annually. These reviews aren't about reacting to short-term market movements, but about ensuring your portfolio still aligns with your goals and risk tolerance. This is also when you'll rebalance your portfolio if necessary. As different assets grow at different rates, your carefully planned allocation will naturally drift. Periodic rebalancing brings everything back into alignment with your target percentages. The beauty of this system is that it requires minimal time once established. Most strategic adapters spent less than an hour a month managing their investments after the initial setup. The system did the heavy lifting, allowing them to focus on their careers, relationships, and passions while their money worked for them. Remember, the goal isn't to become a professional trader or market expert. It's to build a resilient investment approach that delivers consistent results over time. This 30-day plan isn't about getting rich quick. It's about never being poor again. Here's the thing about automation. It's the secret weapon almost nobody talks about. Our new research shows that investors who set up automatic contributions see contribution rates skyrocket from less than 40% to nearly 100%. Why? Because they've eliminated the biggest obstacle to wealth, themselves. The most successful investors weren't financial geniuses or Wall Street insiders. They simply built systems that worked whether they were paying attention or not. Your financial future doesn't depend on picking the next Amazon or Tesla. It depends on creating a framework that consistently puts your money to work through market ups and downs. Start building your automation system today. Set up a recurring transfer, even if it's just $50, to your investment account. This one move puts the entire power of consistency behind your financial future. When you stop relying on willpower and start leveraging systems, you transform from an occasional investor